Most people have never heard of the Fed's reverse repo facility, but what's happening inside of it right now could be the trigger for the next financial crisis, a crisis that could be much closer than anyone realizes, one that could force a Fed bailout and alter the standard of living in America forever. As U.S. borrowing costs continue to soar and foreign demand for debt disappears, the Treasury is running out of options. Now, their temporary solution is to flood the market with short-term debt, hoping that money market funds step in and buy up what's left. But while that might work today, liquidity is vanishing fast. And if these money market funds can't absorb this next wave of debt, well, then we're not just talking about volatility, we are staring down the barrel of a full-blown crash. And yet the Fed already seems to know what's coming. Could it be because the plan is already in place? A quiet systemic bailout that some insiders are already referring to as stealth QE? Because here's the truth, this isn't just a hypothetical situation, it's already happened. In 2019, liquidity vanished, rates exploded, and the Fed was forced to intervene, aka fire up the printing press, to make sure that there wasn't a total funding freeze. Today, the conditions are eerily similar, only the debt is bigger, the liquidity buffer is smaller, and the stakes are higher. And at the center of it all is a little-known mechanism quietly holding it all together. Often called the plumbing of the financial system, the reverse repo facility, or RRP for short, is one of the Fed's many tools that they have available to quietly move money around the system without triggering headlines. Created in 2013 in the wake of the 2008 Great Financial Crisis, the RRP is one of the Fed's many post-crisis tools, essentially mechanisms for meddling in the economy that they had to create to counteract all of the money printing. It's a way to drain excess liquidity from the system and soak up all of the extra cash. And if this sounds deliberately complex, it's because it is. They don't want the average person thinking about this or even knowing it exists, even better. But don't worry, we're going to break it all down together, and I'm going to show you exactly how much stress the system is really under with the chart they don't want you seeing because it's a peek underneath the hood. Now, you can think about it like this. I always explain the reverse repo facility like Wall Street's pawn shop. Big financial institutions come in with something of value, like a Treasury bond. They park it there overnight at the reverse repo facility in exchange for cash with the promise to buy it back the next day. All fine and good. It works just fine until the pawn shop says we're full or we don't want your stuff. When that happens, poof, there goes the buffer for the entire financial system. So while the facility itself hasn't caused a crisis, when it is heavily overused or nearly empty, it signals deeper systemic risk. Now let's look at a chart that shows the funds in the reverse repo facility together. And in 2022, we're going to start here. This is where the facility had the peak, the most funds it's ever had at $2.5 trillion. Now, obviously, this was an excessive amount of funds as a result of all of the excess liquidity in the system from the 2020-2021 spending spree. But can you guess where we are today? If we zoom out, you can see that everything has been tightening. But if you look at present day, there is less than $100 billion left right now today in this facility. Meaning most of the excess liquidity in the system is gone. And you can say, wait, haven't they been tightening for a while? Why does this matter? Well, timing is everything. Right now, the United States is issuing this record amount of debt, right? As this next wave of treasuries hits the system, well, there's a good chance the pawn shop hangs up a "we're closed" sign. What happens then? As I mentioned at the start of this video, this isn't a hypothetical. We've seen it play out in 2020. The same thing happened. And what did the Fed do? They conjured up $400 billion to buy treasuries with, essentially quantitative easing. Now, they claimed it wasn't. They came up with all kinds of terms for what it was. But I can sit here all day long and tell you that water's not wet, but it doesn't make it the truth. But what makes this moment especially dangerous, as I mentioned earlier, is that foreign demand for our treasuries is drying up. So what is the U.S. doing? Well, instead of issuing long-term debt like they usually have, 20, 30-year T-bills. They're instead issuing this short-term debt in record amounts, like last week's $100 billion auction of 4-week T-bills. And guess who it is that's buying those up? Money market funds, the same money market funds who are responsible for all of the liquidity in the reverse repo facility. So if they are piling all of their excess cash into these treasuries, well, then of course we're going to see that repo facility be drained dry. Those in power are playing financial whack-a-mole with our system. They're slapping a band-aid over here on weak demand for our debt, but then over here, they're trying to cover up a liquidity crisis that's popping up as a result. This is what happens when you meddle and intervene in the system. Eventually, you're trying so hard to cover everything up, stability is completely gone. And once this happens, once the money market funds have no more liquidity to give, well, who is going to buy our treasuries then? And before you say the Fed, there actually is another candidate. It's our banks, U.S. banks. Yes, see, now it makes more sense why U.S. Treasury Secretary Scott Bessent has been in the news talking about rolling back 2008-era regulations for U.S. banks that were supposed to protect them against instability, that instability that is the new norm, right? What are those regulations exactly? The SLR, the supplementary leverage ratio, making sure that you have a buffer against your loans and debts, including U.S. Treasuries. Essentially, he is trying to pave the way so that banks can hold more U.S. Treasuries instead of less. Because what could possibly go wrong? What could go wrong with taking debt that the rest of the world is dumping that no one wants, right? As we run out of buyers and putting it into our U.S. banks. Who cares about protecting the depositors? No, let's just have the U.S. banks clean it up. And again, this goes back to that crisis mode where you are constantly trying to find a solution to a new problem, but you're creating 10 more over here, right? I mean, we already saw this happen. In 2020, banks had a ton of cash from the insane spend. What happened? Oh, they thought, let's put it into a safe asset. We're going to put it into U.S. Treasuries. And guess what happened to those treasuries? They lost value. That's why when we look at banks' unrealized losses, they have massive unrealized losses in the last few years. They can't do anything with those assets. They're not assets, they're lead balloons on their balance sheet, right? If they sell them, they become a realized loss, and it exposes just how little they really have. So now they just have to sit there with those. Why on earth would we have banks buy more when they can't even do anything with the ones they have, and the ones they have are already worth less than when they bought them? It makes no sense. And let's not forget, the one bank that did have to sell them, that was forced to sell them, well, there's a reason no one else is. Anyone else remember now failed Silicon Valley Bank, right? That's exactly what happened to them. The second they started selling those assets at a loss, everyone woke up and realized, oh my God, my deposits aren't safe because this bank doesn't actually have anything, right? It's all smoke and mirrors. And I think, again, we all know that day to day walking around. But when it's exposed to you, well, that's when panic sets in. And I'm not trying to initiate a bank run. I'm just trying to wake everyone up to realize this is what's going on in our system. They are not looking out for you. They are looking out to keep the machine running at whatever cost to us. That was a bit of a rant, but the bottom line is that if the repo facility runs dry and the U.S. cannot find buyers, well, then they are going to be forced to issue debt at higher rates. Higher rates means higher interest payments. Higher interest payments means our debt mountain keeps growing. It means that we could expect to see more inflation, rapid inflation, leading to hyperinflation, essentially changing every aspect of our life as we know it today. And I know someone out there is going to go, well, what about the new solutions that they're working on? I've heard something about stablecoins being the savior for treasuries. Yes, you could say that stablecoin is a solution. For me, it's just a band-aid. And in fact, I have a ton of my own concerns about stablecoins, which I've done videos on if you want to go check out. But an oversimplification of a US stablecoin is essentially a digital dollar backed by an equal amount of treasuries. So sure, we'll have all of this money flood into stablecoins, creating an artificial demand for our debt. It will prop it up, but for how long? How long? It's just another game of musical chairs. All it does is temporarily band-aid over the crack, but it does not address the root core of the issue. And on top of that, it's very concerning to me that they could use this as a way to make calls for patriotism or to do your part, right? To support these acts, to support these initiatives. We need it for our country. When in reality, it could just be creating more government control, more surveillance, a lot of things that we need to be paying attention to here. But this is where it really hits home for me, is that all of these supposed fixes, they all come at your expense. Higher taxes, higher inflation. It's extracting more from you and giving you less control over your money. They want you distracted by the headlines. They want you to not notice that the foundation is rotting out from underneath us. But history has shown us time and time again the way that this plays out. Whether it's Weimar Germany or Turkey or Venezuela, we have tons of historical examples, and they all end the same way. The currency holders, the paper fiat currency holders, always pay the price. Not sometimes, not every now and then, always. That is why gold has withstood the test of time for thousands of years, because it doesn't rely on the Fed, on the Treasury, on the system, on promises that we know are going to be broken. That is why gold has been a true wealth protection through all of these currency resets throughout history, each and every single time. This isn't a sometimes, this isn't a maybe. Paper promises, fiat currency, always comes back to its real intrinsic value, which is nothing. Whereas gold protects those and not only sets you up to survive on the other side of the reset, but to thrive. As everything that's going on in our system comes to a head, it is gold that you want to have. I mean, I ask you the question, what would you rather have? A paper promise or a real physical, tangible asset that has withstood the test of time? Now, if you want to learn more about all of these resets throughout history and the parallels that are happening today, we have created an incredible free guide. It is called the Built to Endure. It has tons of data in there, as well as, again, comparisons to today, and most importantly, how gold has protected through all of these resets and how you can use these tools as well. And if you already know all of this and you are ready to create a strategy with physical gold and silver to take your power back from everything that's going on, talk to one of our expert analysts. They have years in helping people just like you. If you call us at the number below, we will happily answer your questions and find out how we can help you create a custom strategy based on your goals, your needs, your concerns, just like we have so many others. You can also click the link in the description below, the Calendly, and set up a time that works best for you. Do it now while you're thinking about it. And again, make sure you get your copy of Built to Endure as well. And in the meantime, I so appreciate you being here. I'm Taylor Kenny with ITM Trading, your trusted source for gold, silver, and lifelong wealth protection. Until next time.